Friends, thank you for being here today. What if I told you that the total collapse of the US dollar might not be the clean slate for your debt that you've been hoping for? And are you truly prepared to navigate a financial reality where the rules of borrowing and lending are rewritten overnight? Let's start by picturing the morning after the anatomy of a currency collapse actually unfolds. Imagine waking up one morning to a notification on your phone that seems like a prank or a plot line from a dystopian novel. The headline reads that the United States dollar has lost its standing as the global reserve currency and has entered a state of free fall. You log into your banking application, the numbers are still there, your checking account still displays a balance of $5,000, your savings account still shows $20,000, nothing has been deleted. However, the reality of those numbers has fundamentally shifted. In the span of a few hours, the purchasing power of that money has evaporated. You drive to the local grocery store only to find the parking lot in a state of chaos. Inside, the shelves are being stripped bare. A gallon of milk that cost $4 yesterday is now being sold for $40. And the clerk warns that by the afternoon, it might be $80. Gas stations have baggies over the pump handles because they are refusing to trade precious fuel for a currency that is rapidly approaching zero value. This is the terrifying reality of a currency collapse. It is not that the money disappears, it is that the faith required to make the money useful vanishes. To understand what happens to your debt in this scenario, one must first understand the mechanism of the collapse itself. A currency collapse is distinct from a recession or a depression. It is a specific economic event where the legal tender of a nation loses its value rapidly due to hyperinflation, a complete loss of faith by international investors, or extreme economic instability. Historically, this has often been triggered by excessive money printing, soaring national debt, and a disconnect between the government's valuation of the money and the market's valuation of it. While the United States dollar is currently a floating currency, meaning its value is determined by supply and demand, in the global market history is littered with examples of collapsed currencies that were once thought invincible. In the Weimar Republic of Germany during the 1920s, the government printed money to pay war reparations, leading to a situation where citizens used wheelbarrows of cash to buy a single loaf of bread. In more recent history, the nations of Zimbabwe and Venezuela have provided grim case studies. In Zimbabwe, the government eventually printed trillion-dollar notes that possessed less purchasing power than a single sheet of toilet paper. In Venezuela, prices began doubling every 19 days, creating a scenario where a person could be a billionaire in nominal terms but still starve to death because the currency could not purchase food. The question that plagues anyone with a mortgage, a car loan, or credit card balance is simple. If the dollar becomes worthless, does my debt become worthless too? The answer is a complex mix of yes and no, depending entirely on the type of debt you hold, the speed of the collapse, and your ability to generate income during the chaos. Now, this brings us to a popular economic theory often called the Inflationary Debt Jubilee, which suggests that a collapse might actually be a gift. The logic behind this is grounded in the mechanics of inflation as a wealth transfer tool. Fundamentally, inflation transfers wealth from lenders to borrowers. When you borrow money, you enter into a legal contract denominated in a specific number of dollars. For example, imagine you take out a mortgage for $300,000. That number is fixed in the contract. If the United States enters a period of hyperinflation, the central bank and the government will likely respond by printing massive amounts of currency to try and pay their own obligations. As this new money floods the system, the value of each individual dollar plummets. Consequently, prices for goods and services skyrocket. In this theoretical scenario, wages eventually skyrocket as well. If a loaf of bread costs $1,000, then a worker's monthly salary might rise to $10 million just to keep up with the cost of living. Here lies the supposed advantage for the debtor. The bank contract still demands the repayment of $300,000. In a hyperinflationary environment where your monthly income has inflated to $10 million, you could theoretically pay off your entire 30-year mortgage with the income earned from a single day of work. This is the scenario that many gold bugs and economic doomsayers fantasize about. They envision a world where they can trade a single ounce of gold or a few dozen eggs for enough cash to wipe out their student loans, their auto loans, and their mortgages. From a purely mathematical standpoint, this logic holds up. Fixed rate debt does not adjust for inflation. Therefore, as the currency devalues, the real burden of the debt evaporates. The lender gets paid back in worthless paper, and the borrower keeps the asset, the house, or the car, essentially for free. However, we have to pause and face the harsh reality of why there is effectively no free lunch here. Economics does not exist in a vacuum, and the real world is far messier than a mathematical equation. While the concept of the inflationary debt jubilee is technically possible, relying on it is a dangerous gamble because it ignores the severe societal and economic trauma that accompanies a currency collapse. The primary flaw in the debt becomes easy to pay argument is the phenomenon known as wage lag. In almost every historical instance of hyperinflation, the cost of goods and services rises significantly faster than wages. When the dollar begins to collapse, the price of food, fuel, and energy will react instantly. A gas station owner can change the price on their sign every hour. A landlord can demand higher rent immediately upon lease renewal. However, wages are sticky. Employers are often unable or unwilling to raise salaries at the same pace as inflation. If the cost of living triples in a month, but your paycheck only increases by 10%, you are effectively becoming poorer with every passing day. In this gap between rising prices and lagging wages, most people do not find themselves with extra cash to pay off debt. Instead, they find themselves struggling to survive. Furthermore, a currency collapse usually triggers a total economic paralysis. Businesses rely on stable prices to plan inventory and payroll. When the currency becomes volatile, supply chains break down. A bakery cannot bake bread if the baker cannot predict the cost of flour for the coming week. This uncertainty leads to mass business closures and soaring unemployment. If you lose your job during the collapse, the fact that your debt is cheap in real terms becomes irrelevant. If you have zero income, you cannot make even a nominal payment. During the collapse of the German mark in the 1920s or the Zimbabwean dollar in the 2000s, the priority for the average citizen shifted entirely from financial management to basic biological survival. When you are worried about where your next meal is coming from or how to heat your home, paying off the mortgage on a house that might be seized by the government or looted by rioters becomes a very low priority. Therefore, while the debt technically shrinks in value, the means to pay it, your labor and income, may disappear entirely. The free lunch of the debt jubilee is often paid for with the destruction of your standard of living. Assuming you can maintain your income, it is important to understand the spectrum of debt because not all loans die the same death. Assuming you can maintain some form of income or possess assets to sell during the collapse, the fate of your debt depends heavily on the specific terms of the loan. All debts are not created equal. We must analyze the three most common types of American debt: credit cards, auto loans, and mortgages, to understand how each behaves during a dollar collapse. First up, let's look at the absolute death trap known as credit card debt. Credit card debt is perhaps the most dangerous liability to hold during a currency crisis. This is primarily because credit card debt is unsecured and carries a variable interest rate. Banks and credit card issuers are not oblivious to inflation. They understand that the money they are lending out is losing value. To compensate for this loss of purchasing power and the increased risk of borrower default, they will aggressively raise interest rates. In a normal economy, a credit card might carry an annual percentage rate of 20%. In a hyperinflationary collapse, lenders will push that rate to 50%, 100%, or even higher if regulations allow. Because the debt is unsecured, meaning there is no physical asset like a house or car for the bank to seize if you stop paying, the lender perceives this as high-risk debt. As inflation soars, the bank realizes that the dollars you pay back next month will buy less than the dollars they lend you today. To protect themselves, they will jack up the interest rate to stay ahead of the inflation rate. If you carry a balance on your credit cards, you will find yourself in a death spiral. Your minimum monthly payment will skyrocket, not because you spent more money, but because the interest charges are compounding at a rate that outpaces your income growth. Even if you manage to make payments, you will likely only be covering the interest, never touching the principal. Eventually, most people with credit card debt in a currency collapse scenario will simply default. They will look at the astronomical interest rates and the struggle to buy food and decide to stop paying the credit card companies. While this might seem like a solution, it carries heavy long-term consequences for your ability to participate in the financial system once order is restored. Next, sitting right in the middle ground, we have auto loans. Auto loans occupy a middle ground in the spectrum of debt. In the United States, the majority of auto loans are fixed-rate debts. This means that if you signed a contract to pay $500 a month for 60 months, that dollar amount does not change regardless of what happens to the value of the dollar. In a hyperinflation scenario, this is advantageous. As wages eventually rise and money becomes abundant, $500 will represent a tiny fraction of your monthly income. You might be able to pay off the entire remaining balance of the car loan with the earnings from a minor side hustle or by selling a few household items that have retained their value. However, the victory is Pyrrhic. While the debt becomes negligible, the asset, the car, is a depreciating liability. A vehicle requires constant maintenance, insurance, and, most critically, fuel. In a currency collapse, the supply chains for spare parts often break down, making repairs impossible or astronomically expensive. Furthermore, fuel shortages are a common symptom of economic collapse. You may find yourself fully owning a car that you cannot afford to drive and cannot repair. So, while the debt itself evaporates, the utility of the asset also diminishes. You win the battle against the lender, but you are left with a rusting hunk of metal that drains your resources. On the other hand, the one scenario where you might find a real strategic advantage is with fixed-rate mortgages. The one scenario where the borrower truly wins is the fixed rate mortgage, specifically if that mortgage is on an income producing asset or a primary residence. This is the double whammy benefit of inflation. First, the debt evaporates in real terms. Just like with the auto loan, your mortgage payment is a fixed number of dollars. If your mortgage payment is $2,000 a month, that number is locked in for 30 years. If hyperinflation strikes and the price of a loaf of bread hits $100, your mortgage payment, which used to be a significant portion of your income, effectively becomes the price of 20 loaves of bread. It becomes trivial to pay. Second, unlike a car, real estate is a hard asset that typically appreciates during inflation. As the value of the dollar falls, the nominal price of the home rises. If you bought a home for $400,000, hyperinflation might push the paper value of that home to $40 million. This creates a massive gap between your debt and your equity. You owe the bank a fixed amount of worthless paper dollars, but you own an asset that is retaining its purchasing power and skyrocketing in nominal value. If the property is a rental, the situation is even better. You can raise the rent immediately to match market rates, perhaps charging $20,000 a month, while your mortgage payment remains fixed at $2,000. The cash flow from the asset pays off the debt in record time, leaving you with a debt-free, high-value asset. This assumes, of course, that the government does not intervene to change the rules of the game, which brings us to the next critical phase of the collapse. Eventually, however, we reach the endgame, which involves currency replacement and repricing. A currency cannot collapse forever. Eventually, the society reaches a breaking point where the old money is completely abandoned and a new system is introduced. This is the end game. Historically, there are two ways this plays out, and each has a different impact on your debt. The first scenario is a government-mandated currency reform. The government might introduce a new dollar and set a fixed exchange rate. For example, they might decree that one new dollar is equal to 1 trillion old dollars. This is effectively lopping off the zeros. In this scenario, the government will likely reprice your debt. If you owed 1 trillion old dollars, you now owe 1 new dollar. Mathematically, nothing changes. You do not get a free ride. The debt is just translated into the new language of money. The second and more chaotic scenario is market-driven replacement. The people simply stop using the dollar and start using something else, foreign currencies, like the euro or Swiss franc, gold or cryptocurrency. In this scenario, the old debt contracts are legally written in a currency that no longer exists or has zero value. You might think, great, I will pay off my mortgage with a wheelbarrow of worthless old cash. However, this is where the legal system steps in. Governments are inherently incentivized to protect the banking sector because a total collapse of the banks means a total collapse of the nation. To prevent this, the government may pass emergency laws that revalue old debts into the new currency. They might say your mortgage was worth $300,000 in purchasing power back in 2024. Therefore, you now owe the equivalent purchasing power in the new gold-backed currency. While it is true that the government itself is the biggest borrower and benefits from inflation wiping out the national debt, they cannot allow the entire private credit market to implode. If every mortgage is wiped out, every bank becomes insolvent, and the economy cannot restart. Therefore, while debtors might get some relief, it is unlikely the government will allow a total debt jubilee where everyone gets to keep their homes for free. We must also consider a major modern constraint that makes this different from the past: the trap of digital credit reporting. There is one major difference between a currency collapse in the 1920s and a currency collapse in the 2020s: the existence of centralized digital credit reporting. In the past, if you defaulted on a loan during the Great Depression or the Weimar hyperinflation, you could eventually rebuild. Records were paper-based, local, and easily lost or ignored. You could move to a new town, walk into a new bank, and start over based on your character and current income. Today, we live in a digital panopticon. Your credit score is a digital tattoo that follows you everywhere. If the dollar collapses and you decide to stop paying your credit cards or your mortgage because you are prioritizing food, that default is recorded on your permanent record. When the dust settles and a new currency is established, the banking system will reboot. Those who defaulted during the crisis will be marked as high-risk borrowers. You may survive the collapse, but you will be locked out of the new financial system. You will not be able to get a loan for a new car, a new house, or a business in the new economy. This creates a powerful incentive to keep paying your debts even when the currency is crumbling, because your creditworthiness is one of the few assets that can survive the transition from one currency regime to another. To fully grasp this, we need to go beyond just the numbers and look at the psychology of collapse. To fully grasp the impact on debt, we must look beyond the balance sheet and into the psychological state of a nation undergoing currency failure. The relationship between a debtor and a creditor is based on trust and the rule of law. When a currency collapses, the social contract that binds these agreements begins to fray. In the early stages of a collapse, there is a period of denial. People see prices rising and assume it is temporary. They might use their credit cards to bridge the gap, assuming they can pay it off when things return to normal. This is a fatal error. As the inflation becomes structural, this additional debt becomes an anchor dragging them down. As denial turns to panic, the velocity of money accelerates. This is an economic concept describing how fast money changes hands. When people realize their money is losing value by the hour, they rush to spend it immediately. They will buy anything, canned goods, electronics, furniture, just to get rid of the cash. This mass spending spree paradoxically drives inflation even higher. For the debtor, this creates a chaotic environment. You might want to pay off your debt, but you also need to convert your paycheck into food immediately before it loses value. The psychological pressure to hoard goods often overrides the logical desire to pay down a loan balance. Furthermore, the breakdown of social order affects debt enforcement. In a severe collapse, banks may close their physical branches. Customer service lines may go dead. Online portals may crash due to traffic or lack of maintenance. You might find yourself in a situation where you want to pay your mortgage to secure your title, but there is physically no way to process the transaction. This administrative limbo creates immense anxiety. Does the bank still recognize your ownership? Are late fees accumulating? Is foreclosure imminent? In the Weimar Republic, the psychological toll was as damaging as the economic one. The middle class, who had saved dutifully in cash and bonds, saw their lifetime of prudence wiped out. Meanwhile, speculators who had borrowed heavily to buy industrial assets emerged as the new elite. This inversion of moral values, where the saver is punished and the gambler is rewarded, tears at the fabric of society. It leads to political extremism and a demand for radical solutions. This is why currency collapses often lead to dictatorships or revolutions. For the individual debtor, this means the political risk is just as high as the financial risk. A new government might sweep into power promising to punish the speculators and hoarders, potentially seizing assets or nationalizing banks in a way that nullifies any strategic advantage you thought you had gained. We also have to talk about a critical factor on the global stage, the mechanism of international trade and the US dollar. The United States dollar is unique because it is the world's reserve currency. This means that, unlike the Zimbabwean dollar or the Venezuelan bolivar, the US dollar is held by central banks and corporations all over the globe. If the dollar collapses, the shock waves are not contained within American borders. They shatter the global economy. For the debtor, this global dimension adds a layer of complexity. If you have a mortgage with a large American bank, that bank likely packaged your mortgage into a security and sold it to investors around the world. Your mortgage payment might ultimately be owed to a pension fund in Japan or a sovereign wealth fund in Norway. If the dollar collapses, these international creditors will be the first to demand action. They will pressure the US government to stabilize the currency or offer compensation. This geopolitical pressure decreases the likelihood of a simple debt jubilee. The United States cannot simply tell the rest of the world that the trillions of dollars of debt owed to them are now worthless. To maintain any standing in the global community and to prevent a war, the US might be forced to peg the new currency to gold or a commodity basket and enforce strict debt repayment terms. This means that the market rate scenario, where the dollar goes to zero and debt vanishes, is less likely for the US than for a small, isolated nation. The international entanglement of US debt suggests that a restructuring is more likely than a cancellation. In a restructuring, the terms of your debt change. The government might say, we are freezing interest rates, but the principal balance is now indexed to inflation. This would be a nightmare for debtors. Imagine if your mortgage balance increased every month in lockstep with inflation, you would never make progress. You would be on a treadmill that speeds up every time you take a step. Looking to the future, we also need to consider a major potential shift in debt management, the role of central bank digital currencies. Many economists believe that the response to a dollar collapse will be the introduction of a digital dollar, fully controlled and tracked by the Federal Reserve. If the government introduces a central bank digital currency to replace the collapsed paper dollar, they will have unprecedented control over your finances. They could program the new currency with specific rules. For example, they could automatically deduct debt payments from your digital wallet the moment you receive income, leaving you with no choice in the matter. They could implement negative interest rates, effectively taxing you for saving money and forcing you to spend or pay down debt. In a digital currency regime, the ability to game the system during a collapse is eliminated. The government could execute an instantaneous, algorithm-driven repricing of all debts in the country. They could scan every mortgage contract and convert it to the new digital unit at a ratio that protects the banks, not the homeowner. This technological capability serves as a warning against assuming that historical patterns of hyperinflation will repeat exactly. Technology allows the state to enforce debt obligations more efficiently than ever before. Given these complexities, let's discuss preparation and protection and how to actually survive this mess. Given the complexity and danger of a dollar collapse, how does one prepare? The goal is not just to hope for a debt jubilee, but to position oneself to survive the chaos and preserve wealth. The most effective strategy is to reduce reliance on the currency itself. This means moving wealth out of paper dollars and into tangible assets. This is often referred to as hard assets. Real estate, as discussed, income producing real estate is a powerful hedge. It generates cash flow that adjusts with inflation and is financed by debt that is destroyed by inflation. Precious metals, gold and silver, have served as the ultimate store of value for 5,000 years. When a fiat currency dies, it usually reverts to its intrinsic value of zero. Gold and silver, however, retain their purchasing power. In a collapse, a silver coin might be the only way to purchase groceries when the credit card terminals are down and paper cash is refused. Self-sufficiency and skills. In the deepest trough of the collapse, financial assets may become temporarily meaningless. If the supply chains break, the most valuable currency is utility. Can you grow food? Can you purify water? Do you have items to barter, such as ammunition, alcohol, or medical supplies? The ability to sustain oneself without relying on the crumbling commercial grid is the ultimate hedge against economic ruin. Foreign diversification. If the collapse is localized to the United States dollar, having assets denominated in other currencies can save you. This might mean holding stocks in foreign companies, owning bonds from stable nations like Switzerland or Singapore, or holding cryptocurrencies like Bitcoin, which operate outside the traditional banking system. The personal debt ceiling. Finally, the best preparation regarding debt is to manage it aggressively before the collapse. Setting a personal debt ceiling, such as never allowing your debt payments to exceed 25% of your income, ensures that you have breathing room. The lower your baseline expenses, the easier it is to weather the storm of hyperinflation. If you can eliminate debt entirely, you remove the risk of the bank seizing your assets, giving you one less enemy to fight during the crisis. Now, even if you manage to prepare, there is a crucial, often overlooked reality we need to discuss: the trap of the paper millionaire. Many people operate under the assumption that once they navigate the hyperinflation and use those worthless dollars to pay off their mortgage, they have won the game. They imagine sitting in their paid-off home, safe and secure, while the world burns around them. But history teaches us a much harsher lesson. You see, paying off the bank is only step one. Step two is keeping the government away from your door. Consider the issue of property taxes. In the United States, property taxes are ad valorem based on value. If hyperinflation drives the nominal value of your modest three-bedroom home from $400,000 to $40 million, your tax assessment will eventually follow suit. Local governments, desperate for revenue to fund failing police and fire services, will aggressively reassess properties. If your property tax rate is 2%, you could suddenly be facing an annual tax bill of $800,000. Even if you have eliminated your mortgage, do you have the cash flow to pay a near $1 million tax bill? If you don't, the county places a tax lien on your home and eventually auctions it off. You didn't lose your home to the bank. You lost it to the tax collector. This isn't just theoretical. It happened in the Weimar Republic. After the German currency stabilized, the government realized that homeowners had reaped a massive windfall by paying off debts with worthless marks. To correct this social injustice and raise revenue, the government passed the Hausensteuer, or house rent tax. They essentially slapped a new mortgage on every debt-free home in the country payable to the government to recoup the value of the debt that had been inflated away. So even if you beat the bank, the government can simply legislate a new debt onto your asset. Furthermore, we must talk about the liquidity crisis. In a collapse, credit markets freeze. No one is lending. This means that while you might be a paper millionaire with a home worth millions, you are cash poor. You cannot eat your drywall. If your roof collapses or your plumbing fails, you cannot take out a home equity line of credit to fix it. You might not even be able to find a contractor willing to work for the currency you hold. You could find yourself living in a dilapidated mansion, unable to afford the upkeep, yet unable to sell because no buyer can get a mortgage to purchase it from you. You become a prisoner of your own asset. Then there is the collapse of the insurance market. Insurance companies invest in bonds and treasuries, assets that are decimated by inflation. In a dollar collapse, major insurers would likely go insolvent. Suddenly, your home is uninsurable. If a fire starts, which is more likely, as public services like the fire department face funding cuts, you are on your own. One spark could wipe out your entire net worth, and there will be no check in the mail to rebuild. Finally, we have to consider the risk of acceleration clauses in a legal breakdown. While rare in standard residential mortgages, many loan contracts have fine print that allows a lender to call the loan due immediately if they believe the security of the loan is in jeopardy. In a total systemic collapse, desperate banks might trigger every legal loophole available to force foreclosures or demand assets before the currency hits absolute zero. You might walk into your bank ready to pay off your loan with a stack of cash, only to find they are refusing payment or tying you up in litigation, stalling until the currency is replaced or revalued by law. This paints a grim picture, but it is necessary to shatter the illusion that debt elimination is a silver bullet. The goal isn't just to be debt-free. It is to be liquid, mobile, and diversified enough to pay the taxes, handle the repairs, and navigate the legal minefield that appears when the old system dies. So, given all of this, let's distill everything down into a summary of actionable steps for you to take. 1. Analyze your debt portfolio today. Identify which loans are fixed rate and which are variable. Prioritize the elimination of variable rate debt immediately. The risk of interest rates spiking to 50 or 100% is a catastrophic vulnerability that must be closed. 2. Secure your income stream. The biggest risk in a collapse is not the debt itself, but the loss of the ability to service it. Diversify your skills. Ensure you have a way to earn value that is not dependent on a single corporate paycheck. 3. Build a liquidity buffer in non-fiat assets. Do not keep 6 months of emergency expenses entirely in cash. Convert a portion of that into gold, silver, or short-term treasury bills of stable foreign nations. This ensures that if the dollar crashes, you have a life raft of value that can be converted back into the currency to make critical debt payments. 4. Do not count on a bailout. Hope is not a strategy. The government acts to preserve the system, not the individual. The banking lobby is powerful and will ensure that creditors are prioritized over debtors in any restructuring legislation. 5. Maintain your credit rating. Do not strategically default unless it is a matter of life and death. Your reputation as a borrower is an asset that transcends the currency itself. When the new system is built, the first question the new lenders will ask is, did you honor your obligations during the crisis? To wrap everything up and bring this home, in summary, if the United States dollar collapses, your debt does not simply vanish into thin air. It undergoes a violent transformation. Unsecured debt like credit cards will morph into a financial shackle with skyrocketing interest rates. Secured fixed rate debt like mortgages may technically become easier to pay off, but only if you can maintain an income and only if the legal system does not rewrite the contracts. The fantasy of the inflationary debt jubilee, where everyone gets a free house and a free car, is a dangerous oversimplification. It ignores the misery of wage lag, the terror of unemployment, and the societal breakdown that accompanies the death of a currency. While the math of inflation favors the borrower, the reality of collapse favors the prepared. The winners will not be those who loaded up on debt hoping for a free lunch, but those who diversified into hard assets, maintained their creditworthiness, and built a lifestyle resilient enough to withstand the death of the dollar.